everybody on the finance Twitter is screaming that the private credit is the next bubble, right? Institutions say, relax, it's fine. So who's right? And more importantly, how would you even tell the difference between them before it's too late? So here's the players. The same names from the PE, Blackstone, KKR, Ares, Apollo, plus Churchill, Benefit Streets, Monroe. Blackstone market is back credit fund to affluent investors. The concentration just in Q1 2026 alone, the snapshot showed that the five largest private credit funds grabbing about 60% of all capital raised. Churchill did 16 billion senior loan strategy. Goldman Sachs asset manager about 13 billion mezzanine fund. Ares a multi-billion dollar credit secondaries fund. Is there really a bubble? This is all Q1 2026 for private credit alone, right? They have the fastest growth, the leverage, amend and extend deals, the covenant-like terms, the valuations, the losses can get pushed into the future. Like, these guys are winning and they're going after it. On the other side, JP Morgan and others are saying that private credit is still under 10% of total corporate borrowing. So we got a 16 billion from Churchill, Goldman Sachs 13 billion, multi-billion from Ares, not a specific number, but 60% of all capital raised toward private credit. But from a noteworthy standpoint, 10% of the total is private credit is still 10% of the total corporate borrowing, which means it's not huge leverage on this side, right? So the leverage and realized losses look manageable because of its senior secured lending with direct borrower engagement. Right. So at iCapital, Sonali Basic points out that defaults and losses, not headlines, are what matters. So far as private credit quality is held up, the headlines, guys, we got to ignore. What's actually happening here? And we just did the numbers. 60% of all capital raised for private credit, right? But when we look at the total market share, and this is probably based off the large of the public markets for sure, because that's where you get the most access to information, it's still 10% or it's under 10% of the total corporate borrowing. So is it really a bubble or is it managing really how it's supposed to, right? As long as the quality is held up, how do you ensure the quality of there is held up? By investing in the right companies. The same way you're going to pick out for your private equity deals, your venture capital deals, and your other deals, you want to secure and make sure that whoever you back is going to be back good. That's one. Insofar as that they can return the capital, grow their company for what they intended to borrow this dollar from, and that they're not over leveraged in doing so. Right? So now here's where almost everyone gets it wrong. You hear a bubble and you picture 2008. Oh my God, the stock market's going to crash. Everything's going to crash. I'm going to lose my house. I'm going to lose my shirt. Well, the sudden explosion, mortgage blowing up overnight, but that's not the real risk here. The real danger isn't a bang. It's the slow burn, right? It's those loans, the deals that let struggling borrowers look perfectly healthy on paper for years. So the threat isn't the size of the market, it's the fog. You can't see the stress until it's already deep, right? It's the headline number. That's the thing that's going on here, right? And that fog matters most for the people who can least afford a surprise. So if you're borrowing and you're already risk and you can't afford like a fail, you have no room for failure here. That's where the risk is, which is why on that credit side, these firms are leaning in heavily on evaluating deal by deal by deal. Who's the best people to fund the deal to? Can they return capital? What do their assets look like? Can I like you? Can I trust you to return capital? Assuming that all things is good, everything in business is a risk, especially when you're trying to borrow money for the growth. It's all risky. But what can we do to mitigate the risk? How can we ensure from the investments that we make that we mitigate this risk and get a return on investment, right? And that's what you want to do. So what you want to watch out for. The biggest stake of this thing is for generations, bank underlent in the black neighborhoods and to black-owned businesses, credit deserts, the long shadow of redlining, rigid underwriting that said no before it said hello. Now, there's a brand new source of capital that doesn't run on the bank's rule book, right? Think about that. For years, black people have been marginalized, redlined, not even accepted. Walking in the door, you already got denied for the loan, right? So this is either the biggest funding opening for black entrepreneurs in a generation, or is a brand new way to get taken advantage of. And right now, technically, both are on the table because of the private credit opportunity. We don't know what's going to happen, right? Do we just assume that lending is going to happen like how it always or traditionally happened? I wouldn't assume that. The opportunity is there. The private credit gives an opportunity for you to get funded in non traditional ways, which is how most wealth gets started.